For nearly 7 decades, employer-based coverage has been a cornerstone of the United States healthcare system. At the same time, healthcare benefits have long been a core component of the total rewards that companies use to attract and retain talent. But the American health insurance system, and probably your own company's healthcare, will continue to undergo changes this year, reflecting the new compliance responsibilities under the Affordable Care Act. Not only will accountants and financial executives be concerned with their information reporting requirements, but they will also be facing a wider range of interrelated considerations. Should the business continue to offer employee health insurance at all? Should active employees or retirees be transitioned to private health insurance exchanges? How much should be invested in health improvement and wellness programs? And what is the risk from the 40% excise tax known as the Cadillac tax?
Of course, in recent years, the impact of legislative and regulatory developments on employer-sponsored health care plans and compliance has been never-ending. Bring us up to date is Dorian Smith, an attorney and partner with Mercer, who monitors and analyzes the ongoing effects of healthcare-related developments for their Washington Resource Group. Thanks for joining us this month, Dorian.
My pleasure, Becky.
Well, we've heard every year since the enactment of the Affordable Care Act that this is the year when employers must pay attention to and must implement health care reform. From your perspective, Dorian, is this really the year that everything is ready to be put into effect?
This is a big year. This is definitely a big year. This is the year that, effective 1/1/2015, the employer shared responsibility mandate came into play, which means that large employers, and we'll talk about that in a little bit, need to offer their full-time employees a certain level of coverage at an affordable value, or potentially pay penalties to the government. And also, this is the year that employers are going to be required to start tracking the hours of their employees, because there is this voluminous reporting, Becky, that you may have heard of, that is going to be first due to employees and the IRS early in 2016 based on the 2015 data, the 2015 health plans, and the 2015 employees' hours.
Thanks, Dorian. We'll return to your commentary in a minute.
The good news is that the Affordable Care Act does not require businesses to provide health benefits to their workers. But the not-so-good news is that large employers may face penalties if they don't make affordable health coverage available to their workforce. Specifically, the employer shared responsibility provision of the Affordable Care Act penalizes so-called applicable large employers who either do not offer coverage to their employees or who do not offer health coverage that meets minimum value and affordability standards. You may recall that for 2015, there is transition relief from the penalty for those businesses that employed between 50 and 100 full-time equivalent employees during 2014. However, to be eligible for relief, the employer, 1, cannot have reduced the size of its workforce or the overall hours of service of its employees, 2, cannot have eliminated or materially reduced the health coverage it offers, and 3, must have employed on average at least 50 full-time employees, but fewer than 100 full-time employees during 2014. You may recall that employees are considered full-time for a calendar month if they average at least 30 hours of service per week or 130 hours of service per month. Now, generally in 2015, an applicable large employer will be subject to a shared responsibility payment once at least one full-time employee receives a premium tax credit and A, the employer offers health insurance coverage that is not affordable or does not meet the minimum value standards. In this case, the penalty is $3,000 for each employee who opts out of the employer's coverage and obtains their health insurance through an exchange where they are eligible for a premium tax credit. B, the employer does not offer health insurance coverage to at least 70% of their employees. Here, the penalty is essentially calculated at $2,000 per employee.
Since the Supreme Court's decision earlier this year, there really isn't any doubt that the so-called employer shared responsibilities will be in effect. And since I've heard that mandate is also called play or pay, Dorian, tell me, how do we play and when do we pay?
Well, that's a good question, Becky. What play or pay means is that employers, large employers, and when I say large employers, I generally mean employers with 50 or more full-time employees in the prior year, and that also includes full-time equivalent employees. Those types of employers need to or have an interest in offering their full-time employees affordable minimum value coverage and that would be playing. And if they don't do that, they are exposed to potential assessments, and that is the pay part of the play or pay. There are obviously a lot of rules and details behind all of what I've just said, but that's the very basic, the high level of what a play or pay is.
What you said makes sense, Dorian, even to me, but remind me, isn't there also an additional penalty when a full-time employee is offered coverage that is not affordable? What happens when that employee then decides to purchase coverage through an exchange, where he or she qualifies for a premium tax credit?
That's a good question, Becky. The first thing you have to understand is that the employees that we really care about for this purpose are full-time employees. And that is an employee who works on average 30 hours a week or 130 hours a month. And there are a variety of different ways on how you measure employees' hours. But once you've identified who your full-time employees are, it's those types of employees who, if you don't offer them affordable minimum value coverage, and they go to a public exchange and receive a subsidy or federal monies to help them pay for that individual coverage, that type of full-time employee could trigger a $3,000 or pro rata share of the $3,000 penalty for the employer.
Okay, but what about those employers who choose not to play? How much will they be expected to pay for the privilege of not offering health insurance to 70% of their employees?
Becky, that's a choice. Employers can decide that they don't want to be in the game of health coverage anymore, that there are other options out there. And if a large employer decides that it no longer wants to offer health coverage to employees, or specifically doesn't offer coverage to a requisite percentage of its full-time employees, then that employer could potentially be on the hook for a $2,000 penalty times all its full-time employees minus a handful. And again, sort of keeping this high level, Becky, but there are a lot of rules behind what I just said.
All right, let's make sure I understand, Dorian. Isn't there a difference, at least for 2015, between those companies with 100 or more full-time employees and those with between 50 and 99 full-time equivalents?
You've been doing your homework, Becky. There is. For this first year in 2015, from a substantive perspective, employers with 50 to 99 full-time employees get a pass from any penalties. So those employers don't have to offer affordable minimum value coverage to their full-time employees in 2015. They get a pass until 2016. However, those employees, those 50 to 99 employees, they still are responsible for reporting. So those employers still have work to do. They have to measure their hours of their employees. They have to issue reports to the IRS and to the employees early in 2016. So they're not out of the soup. They're just out of the penalty.
I know that at one time, Dorian, you served as an attorney at the Department of Labor. Wasn't there an expression from ERISA involving controlled and affiliated service groups? So what happens in the healthcare world when you've got a number of businesses with 50 employees, but they've all got some degree of common ownership?
Well, Becky, this is actually a pretty complicated question that you're asking me. And to try and boil it down, this is really an IRS rule. So there's an IRS concept of control group of corporations. And what that means from a very high level is that you have a parent company who may own 80% of a subsidiary, and they're part of a control group. There are these other concepts of brother-sister corporations. And what I think you're getting at is that to determine whether or not you're a large employer, again, whether you have 50 or more full-time and full-time equivalents, or 100 or full-time equivalents, you take a look at all of the different employers within that control group, and you add up the employees, and if they aggregate to over 50 full-time or full-time equivalents, then every single employer within that control group is subject to player pay and reporting, even the ones that have less than 50 full-time employees.
For many businesses, it's not just meeting the new pay or play requirements that's so difficult. It's also the information reporting that's now required. As you mentioned, the first reports for the 2015 calendar year are due in early 2016, aren't they?
They are, and this is something that employers are really struggling with. These are reports, and to be technical, they are the forms 1095-C and 1094-C that employers are required to complete and send to their full-time employees and send to any employees who are covered under a self-insured health plan by February 1st, 2016, based on the 2015 calendar year. In addition, employers are required to send these reports to the IRS along with another report that tells the IRS about information regarding their player pay compliance or lack thereof generally by March 31st, 2016, or by February 29th if that employer happens to file by paper.
You know our viewers, corporate financial executives. They work closely with and sometimes supervise the payroll function, the tax group, and the HR staff. How do you decide who's responsible for issuing forms 1094 and 1095?
That's a great question, Becky. And when this rolled out, I think you saw a lot of different units in a corporation pointing at each other saying, you take control, whether it was the tax department or the finance department or HR. Really, I view this as more of a benefits issue. Even though this is a tax form, it is reporting information about people's coverage, about the affordability of coverage, about whether they were offered coverage. But it also involves hours counting. So even if somebody wasn't offered coverage, you need to know, were they a full-time employee? And that may not necessarily be in the benefits department. That may be in a separate HR department. You may need to take into account somebody's FMLA hours, and so that may be in a different department. You need to know whether somebody was covered under a plan, and that will be in the benefits department, or that will be with an insurer. So really, there are a lot of departments that are going to need to work together in order to complete all of the necessary information on these new forms. And so what I've been telling my clients is that, if they haven't started this already, and they should have, but if they haven't, this is really the time that they need to accumulate that data, understand where that data is, get a vendor if they have not already secured a vendor to help them with this. And a lot of my clients are using third-party vendors. But really, there's no more time to delay on this one. You got to get going because the reports, like I said, are due February 1st. And while there may be an opportunity to get some sort of extension, it's certainly far from a certainty at this point in time.
Well, I don't want to get too far into the weeds, Dorian, but can you remind me, what are the forms that employers should be issuing starting this year?
So there are the two forms that are most relevant for employers are the 1094-C and the 1095-C. The employees that get a 1095-C fall into two buckets. It's one, any employee who was a full-time employee, an ACA full-time employee, for at least 1 month in 2015, and or any employee who was covered under an employer's self-insured health plan for at least 1 month of the year, even if they weren't a full-time employee. So those two groups of employees are going to intersect in many instances, but you could have some non-ACA full-time employees who are covered under a self-insured health plan who need to receive a 1095-C, and you could have some full-time employees who are not covered under any plan that also need to receive a 1095-C.
Well, besides Form 1095, you also mentioned Form 1094. How's that different?
So the 1094-C is a report that goes to the IRS, a transmittal report that is due to the IRS generally by March 31st for electronic filers or February 29th for paper filers. And what that report does is it attaches a copy of all of those 1095-Cs that you sent to employees. It sends a copy to the IRS, sort of like a batch W-2, and it also provides the IRS with some additional information regarding the employer's player pay compliance or lack thereof.
Okay, but what about those companies that self-fund their insurance as opposed to using a third party? Are there special reporting rules for them?
Well, Becky, as I mentioned, the reporting rules are the same, except for those who self-fund, they may actually have more reports to do than your fully insured counterparts because, like I said, they do have to report on the coverage for any individual, employee, retiree, spouse, who is covered under their self-insured health plan for at least 1 month in 2015.
Did you happen to notice, Dorian, that recently enacted legislation significantly increased the penalties for incorrect or incomplete information returns? I assume these new penalty amounts apply to healthcare payee statement, too.
They do. So earlier this year, as part of legislation that was enacted, the government increased the penalties from, I believe, $100 to $250 per form, with caps at $1.5 million now to $3 million for incorrect or missing forms. And that includes these two new 1095-Cs and 1094-Cs. But there's some good news here, Becky. For this first year, as long as employers make a good faith, reasonable effort to comply with reporting, and they actually do file in a timely manner, there won't be assessments for any errors or omissions of these reports. But again, importantly, employers cannot blow off this reporting. They have to do it and have to do it in a timely basis. They just don't need to be so concerned about the one-off errors that might occur because penalties are waived for this first year.
Another provision that was included in the budget legislation was the repeal of the automatic enrollment provisions for health plans. Since I don't know any companies that have installed these provisions, tell me, what impact, if any, will the repeal have on our viewers and their health plans?
You're right, Becky. In fact, just recently, the Budget Act that was signed into law repealed the never implemented automatic enrollment provision under the ACA. It's, I like to call it, we never got to know you provision. And that provision required employers with 200 or more employees to automatically enroll their employees in a health plan or continue the enrollment of current enrollees. Because that provision didn't take effect until the regulators issued regulations, and because the regulators never issued regulations, it's been sitting dormant. Well, now it's just gone. It's been written out of the law, and so we don't have to worry about monitoring that going forward. That said, there still is automatic enrollment in 401k and other retirement plans, so not to be confused with the repeal of the automatic enrollment for health plans, automatic enrollment for other types of qualified retirement plans is alive and well.
Speaking of recently enacted legislation, I saw that Congress passed and President Obama signed the Protecting Affordable Coverage for Employees Act. How does this PACE Act amend the definition of small employers?
So when the ACA was enacted, it proposed to change the rules for what was defined as a small group or a large group. And by 2016, any employer with 100 or less employees was supposed to be in the small group market. And that had some negative consequences for employers, particularly for employers between 50 and 100 who used to be in the large group and now were going to be placed in the small group and had different rules that their plans had to abide by, and really was increasing the cost of coverage in many instances. Helpfully, what this PACE Act did is it allowed it allowed states to keep the definition of small group at 50 and allow those employers with more than 50 to be in the large group. But that's a state option. Some states have decided to expand their large group market, and we don't know if they're going to change it, such as New York, while other states may, in fact, keep their definition of small group from 1 to 50 or 2 to 50 and allow those with above 50 to remain in the large group market, which, from what I understand in speaking to clients, is going to be advantageous from a premium perspective.
Many of those small employers have historically provided some of their workers with employee reimbursement plans. Those are no longer allowed, are they?
Right. So even ever since 2014, the IRS has said you no longer can provide your active employees with money to go out and purchase individual coverage. That has been a result of the ACA and various ACA mandates. There was a delay for smaller employers and S-corps until June 30th of 2015, and even for some until the end of 2015. However, now that we're at the end of 2015, those employers as well are not allowed to provide their active employees with money to go to a public exchange and purchase coverage. That's a violation of various ACA provisions. Employer cannot give active employees money to go to purchase public exchange health coverage. On the other hand, for retirees, an employer could set up a retiree-only HRA, which can reimburse pre-65 retirees for the cost of their health coverage that they purchase in the individual marketplace. There is an important distinction there to realize. Retiree-only HRA is permissible under the ACA, but a standalone HRA or monies to purchase individual coverage for active employees is not.
Well, many companies are so overwhelmed by the employer mandate and by their information reporting responsibilities that they may not have looked at the fine print. For example, aren't there also new rules and cost-sharing limits for the annual out-of-pocket maximum amount under a group health plan?
There are, Becky. So the ACA, as part of the ACA, there's a provision that limited the out-of-pocket expenses that could be incurred by an individual. And when I talk about out-of-pocket expenses, what I'm referring to are deductibles, co-insurance, co-pay, on an in-network basis. And the ACA sets certain limits on that. Now, this has been in place since 2014, But there has been a tweak to this rule effective 2016. And to explain it at a somewhat high level, for family coverage, there may need to be an embedded individual out-of-pocket max that doesn't exceed the threshold for individual out-of-pocket match, which I believe in 2016 is $6,850. So some plans that have family out-of-pocket maxes that exceed $6,850 for in-network coverage are going to need to make some decisions on how to rectify that in order to comply with this new out-of-pocket max provision.
And presumably there is still the alphabet soup of so-called federal group health plan mandates, everything from COBRA and HIPAA to Gina and Michelle's law, right?
The ACA has not replaced COBRA or ERISA or the Internal Revenue Code or that alphabet soup of regulatory or statutory mandates.
Just when you thought it was safe to go in the water, there's a looming threat to compliance with the Affordable Care Act when the so-called Cadillac tax goes into effect. Under the ACA, certain employer-sponsored coverage will incur a non-deductible 40% excise tax beginning in 2018 on the cost of employer-sponsored coverage over a threshold amount. According to early indications, the thresholds for 2018 are likely to be $10,200 for single coverage and $27,500 for family coverage. As you might expect, the Cadillac tax is most likely to be incurred by organizations with historically generous health benefits packages and by those businesses with less healthy or older populations, as well as companies with operations in geographic areas with high health care costs.
For years, Dorian, I've heard about upcoming 40% non-deductible excise tax on high-cost health plans. Notice the Cadillac tax. All of a sudden, 2018 is really around the corner, isn't it?
It certainly is, Becky. This is the last shoe to fall, the last ACA shoe, so to speak. This is a Cadillac tax, as it's referred to, that imposes a 40% excise tax on employers that offer their employees a certain level of coverage that the government deems to be too rich. Employers should be preparing today for that excise tax and looking at their plan designs and looking at what types of plans they want to offer going forward in order to limit their exposure, because the clients that I've spoken to, none of them are going to want to pay 1 penny toward that excise tax and are doing everything possible today in order to mitigate their exposure.
Well, I don't think any company would relocate from an area where there are relatively high healthcare costs just to escape the Cadillac tax. But it is possible that some businesses might consider redesigning their benefit packages in order to delay incurring the tax, isn't it?
Becky, you're absolutely right. And not only would financial executives consider this, they are doing this. There is no doubt that if an employer has modeled out their plans to 2018 and realized that their plans are going to hit or exceed the thresholds being $10,000, $200 for single coverage or $27,000, $500 for other than self-only coverage with certain additional adjustments. If they have modeled that out to have their plans exceed, they're doing whatever they can today in order to make sure that those plans do not trigger any sort of excise tax.
Well, for a couple of years, Dorian, advisors from your firm recommended that our viewers consider updating the health savings accounts that they offer. But isn't it possible that a well-funded HSA plan could actually trigger the Cadillac tax?
Becky, you're absolutely right. While the underlying health plan, the high deductible health plan, is a good type of plan vis-a-vis the excise tax because the underlying plan itself has a lower value than, let's say, a rich PPO plan or a rich HMO plan, the side account, the HSA, in certain instances, the monies in there will accumulate toward the excise tax. And which monies accumulate? Any employer contributions to that HSA, such as a seed contribution or a wellness incentive contribution or a matching contribution, will accumulate toward the excise tax. And based on what we know today, any employee pre-tax contributions to that HSA, and when I say that, I mean pre-tax being made through the employer's cafeteria plan, those also will accumulate to the excise tax. Now, it could be that some legislation or changes to the law at least exclude the employee pre-tax contributions, but as of today, that's not the case. And so employers are really going to think about what are they going to do in the future to the extent that they offer these plans, but still want to make sure that monies in that HSA are not accumulating toward that excise tax calculation.
I guess cost considerations aren't only about the Cadillac tax, is it? I've heard about employers who no longer offer medical coverage to their pre-65 retirees. In some cases, doesn't it make sense to send those retirees to the exchanges where they may qualify for premium subsidies without triggering penalties for the employer?
That's a great question, Becky, and that's really a matter of corporate culture. Some employers may decide that, yes, there's now a viable individual marketplace out there where pre-65s can go, get individual coverage, not be medically underwritten, may actually have subsidies available to them based on where they live and based on their household income. And so that may present a better opportunity than they've ever had. On the other hand, some employers that feel that they want to stay in the game and want to continue offering their pre-65 retirees health coverage because they feel that's the right thing to do, and they're not comfortable yet sending out their pre-65 retirees to a marketplace that's still in its infancy stage. I mean, it's only been 2 or 3 years now that the exchanges are up and running, and there are some pitfalls with exchange coverage that we all know about, narrow networks, and so some employers have not decided to completely pull the plug on their pre-65 retiree programs. And the third option is that some employers have decided that they are going to send their employee pre-65s to the exchange, but they're going to give them some money to do that. They're going to seed maybe a retiree HRA, which will allow those retirees to take some employer money and purchase coverage in the exchange. But realize doing that may jeopardize the retiree's ability to also get subsidized coverage from the government.
I suppose if you're counting heads, Dorian, for purposes of reinsurance and PCORI fees, then you'd also consider whether to offer coverage to spouses, wouldn't you?
Well, Becca, that's an interesting way of looking at it. I would say that certainly employers are looking at whether or not to continue offering coverage to spouses, or if they do continue to offer coverage, whether they will impose a spousal surcharge so that if that spouse has access to coverage at their employer, then if they want to join the employees plan, it will cost extra. I'm not so sure that decision is necessarily driven by the PCORI fee or the transitional reinsurance fee, but it is definitely being driven by cost. And incidentally, getting back to something we were discussing earlier, Becky, under the player pay rules, the requirement is that the employer offer coverage, minimum essential coverage, to the employee and their children to the end of the year in which they turn age 26. There is no requirement to offer coverage to spouses. So if an employer decided to completely pull the plug on offering coverage to spouses, that doesn't present any exposure under the player pay rules.
Well, since we're discussing costs, I know on the one hand, some companies are providing so-called wellness benefits to their employees. But on the other hand, there's certainly a cost associated with providing those benefits, isn't there?
There is. Wellness is a very hot topic, and as I like to say, you've seen one wellness program, you've seen one wellness program, and there are pros and cons to wellness programs. The cons, as you mentioned, is that there is an upfront cost to them, investment in them, figuring out what you want to offer, certainly the incentives that you might want to offer. And so you're putting in something upfront. The benefit for these wellness programs, one, is that there's the potential for a nice return on investment. Some companies have seen this return on investment, some are still waiting, but that's the goal, that these wellness activities are going to get the employee population healthier, which will ultimately reduce the cost of medical plan coverage. In addition, wellness is a nice thing to have. Some employers may find that giving their employees access to wellness programs is just a nice thing to do, and it makes the employees feel like they're a place they want to be.
Well, as you'd expect, our viewers, as stewards of their company's assets, have been concerned for many years about the increased costs associated with compliance, as well as with coverage in the health insurance sector. Since you brought your crystal ball with you, Dorian, tell me, are we in for any relief?
Well, Becky, I wish I could tell you with some certainty, but my guess is that we're not in for any relief. I think that compliance is here to stay. While player pay goes and becomes more of rote activity and reporting comes and goes, I mean, it's not going to go, but it will become like other things, like W-2 reporting. Employers will get used to it, but it's sort of like whack-a-mole. We would knock that one down, and what's going to pop up? Well, you know what might pop up? figuring out excise tax exposure. That's going to be a big deal over the next 2 or 3 years. There are these non-discrimination rules that are sort of in the pipeline that may require employers to start taking a look at whether their fully insured plans are compliant with non-discrimination rules. To date, fully insured plans have not needed to be compliant with non-discrimination rules in the same way that self-insured health plans. There are cafeteria plan non-discrimination rules that have been sitting dormant since August 2007. Eventually, those are going to become finalized. So while we think we're over most of the big humps from the ACA perspective, I do know for certain that we have more compliance in the future.
Well, you've certainly covered a wide range of topics for us, Dorian. If our viewers could take one thought away from this discussion, what would you like that to be?
I'm glad you asked me that, Becky. I think the one thing I'd want employers to take away is that while there are a lot of compliance obstacles to overcome, these compliance obstacles should not get in the way of an employer's decision to continue to offer benefits to employees, because as we know, employers reap a benefit from that and employees reap a benefit from that.
Mercer's Dorian Smith, thanks for bringing us up to date.
Well, Becky, thank you for allowing me to be here.